Hello and welcome, everyone. Thanks for joining me today on the podcast. It's great to have you here as always. We love putting these together and hope you're finding a lot of benefit and value out of them. I'm your host, Ben Martinek, Catholic Financial Planners Network. And on our show today, we have yet another advisor who's part of the network, recently joined, a new fellow from the East Coast. We're starting to see quite a few of them, it seems, to be pulling up from there. So it's good to have that representation. Nick Orenduff with Orenduff and Associates out of Richmond, Virginia, is joining me today. Nick, if you wouldn't mind, could you just you may say hello and say a few words about yourself and some of your business for the audience?
Yeah, absolutely. Thank you, Ben. Thank you for having me on the show today. It's a blessing to be here. And as Ben said, I'm Nick Orenduff, based in the Richmond, Virginia area, so in the capital area of Virginia. And we have been in the financial planning business since 1974. I haven't, but my father started the business then, and I joined in 2004. Certified financial planner. So now I've been in the business 20 years, but the Orenduff and Associates, we just had our 50th anniversary this year. So very thankful for all those years of being able to work with wonderful clients, wonderful people, and having a business to go along with it.
Yeah, that's awesome, Nick. It's not every day we get to we have a business or someone on the podcast who's been in the business, or at least has a business that's been around for 50 years. It's pretty remarkable and quite the accomplishment. It makes me almost curious. I don't want to delve into this too much because it'll be bringing us off topic. But your dad started the business in the mid 70s and got it going and running strong. And you decided to step in and take over the reins. And how's the last 20 years been for you? Has this been a positive experience as you've stepped into helping to run the business?
Yeah, it's been a wonderfully positive experience. And there's never a dull moment. So for someone like me who likes to learn and meet people and help people, it's a great business to be in. It has changed a lot since I joined in 2004. When I joined the business, did not look really at all like it does right now. So I started working with large group retirement plans. So we worked with some large employers in our area in Virginia, some other states as well. You may have heard of 457 plans, 403B plans, 401k, so forth. And then we helped people on an individual basis as well, retiring. But now since about 2011 or 2012 or so, we focus pretty much entirely now on working with individuals and families, whereas before we had an institutional area as well, but now working directly with individuals and families on their financial planning and retirement planning and estate planning needs. So it has changed quite a bit from when I got involved.
Yeah, well, I think that's going to be a great segue, Nick. Thanks for sharing some of your background and the prior history, because our topic for today is just to get into this notion of what is investing. When an investor approaches or a client approaches and says, "Hey, I want to invest my money," or "What kind of options do you have for me?" We kind of just presume maybe what investment is, but there aren't many times that we get a chance to maybe answer that question fully or at length. And what I'd like to have is just a conversation with you today on what investing is and what your investment options are and investment vehicles are out in the marketplace, and part of why those are structured the way they are and how they can be a benefit to the user, and maybe even at times what times you would perhaps consider using one investment type over another investment type. And I think what's interesting about all of that is at the heart of investing is this notion that it's really just about having a business and running a business and even growing a business. And just whether that's a family business or a larger entity, it's kind of all the same. And how, maybe as we start this off, would you consider or think of investing, especially as it relates maybe into your own family business? Like, do you have some thoughts or perspective on that? Even just with the changing of the business in the last 20 years, I'm sure there's been some investment on your part to make that happen. Like, what does it mean to you, to invest? And why don't we leave it? I've hit you with about 20 questions. We'll We'll leave it with
Yeah,
just that one for now.
I think we could go a lot of directions with that, and there's a lot to talk about with investing for sure. That's why there's tons and tons of shows and books on investing. But getting to the
Sure.
basics here, I think you brought up a really good point, Ben. Let's talk a little bit about what is investing, what's an investment, why do you do it? So to me, I think investing is, I think most people think about investing as you put some of your hard-earned money aside, your capital, and with the idea of either producing some income or some appreciation, making that capital grow for you. So either income or appreciation or a combination thereof. But you mentioned family business as well, like ours. I think investing can also be, besides the monetary capital, also an investment of energy and time and dedication, and that also goes into the investing as well, especially if you're more of an active investor versus a passive investor as well. So I think the Latin meaning of investing is investir, something like putting your clothes on, right? So it's taking something on,
Yeah.
taking on a responsibility. And you can do that. You can put your capital to work in a various different avenues, like you already touched on, Ben. So, popular avenue is obviously the public market, the stock markets, the bond market, and we'll talk more about that. But private businesses as well. There's a lot to consider with investing. So we'll take it from there.
Yeah, for sure. I mean, I think you're right. Investing at the most basic level is this notion of taking on a responsibility. And it's an allocation or a commitment, a focus of resources, if you will. And many times we're thinking of that focus of resources being associated with money, just cash. Like I've got some extra money laying around. And again, what we mean by money is cash. And, where should I be putting that? But, cash isn't the only resource or asset that we have available to ourselves. And maybe some of the more powerful ones would be, our time, our intellect, our dedication, the commitment of our wills. We all have so much available resources in our life. And so investing is really kind of a question at the same time of prioritization. Where do we want to be focusing our efforts? And, the returns we tend to think that come with the notion of investing, where we want a return of that time or that money, will vary depending on, what are you pursuing? Is it an investment in your family, or maybe an investment in your health, an investment in your business or your education, or, could just be it's an investment in a business opportunity that you're pursuing in the capital markets, and you're just a stockholder. That's probably the most simple, really, of the different ways to invest and dedicate it to ourselves. So, we could spend a lot of time just talking more broadly about investing. I think what we'd like to stay focused on is just like investing now, having thought of it in this broader notion. What is investing when we're talking about really the work that we do, where folks are looking for an investment advisor and the capital markets? Like, maybe just to give you some direction on this, like if someone says, hey, what's a stock? Like, I don't even know what that is. Like, what kind of response would you give to that, Nick? Like, what's the answer?
So a stock would be ownership in a corporation. So you're basically taking an ownership position in that company. So for example, if you're buying stock in IBM, you are now an owner of IBM, even if it's a very small piece compared to the whole. You are an owner. You do get to vote on certain resolutions and so forth. So you get some responsibility with that, and with that piece of capital that you put into IBM, for example, you participate in that company's successes or failures to a certain degree. So if the company is successful, your investment will grow along with that. If it's able to pay dividends, you will receive the dividends that are allocated per your shares that you're purchasing. But if it's not successful, obviously you will have a negative effect from that as well. So it's very important to discern when you're investing, discern where you want to put that capital, what company, what stock you might want to buy. Hopefully it's not just one, but we'll talk about diversification in a little bit too, but you basically become a part owner of that company. It's a very broad category, right? So you have large company stocks, which could be over $10 billion in value and up. And then you have smaller company stocks between, mid-sized companies between 2 and 10 billion, and then smaller companies that are less than 2 billion in size. And then maybe your micro caps that are smaller than 250 million. So there are, thousands of stocks out there. So it's quite a broad universe to choose from. And we're fortunate here in the United States to have such a large selection and such a developed financial market to be able to give us opportunities.
For sure, to be able to buy into these businesses and their operations and the goals or the agendas or the market, their take on the marketplace and what they want to provide. And hopefully, I mean, the goal of any business is to turn a profit, right? A business isn't going to be around for very long, whether that, a two-man shop, such as, which you have in your own financial planning, mom and pop, practice versus, maybe one of these mega companies, mega giants as they refer to them, that has, 50,000 or 100,000 in employees. It's still the intent of, some of a company that large, or maybe to speak obviously to turn a profit. So what, but why do they issue? Could you speak a little bit, Nick? Why do you think a company issues stock? What are they hoping to objective, and what's the investor hoping to receive from that? Like what's the benefit of, all this stock that's getting issued?
Sure. So I think, companies issue stocks so that they can have more capital to work with. So working capital, issuing equity or stock actually provides that capital that they might need to put towards positive uses. So if they're able to allocate that equity, that capital well, they can put them into ventures, parts of the company, or new projects that have an expected return above that of a baseline return. So hopefully the equity that they're generating by selling stock in the market. So assume you buy that stock, that money that you use to purchase your shares of stock goes into that company, and then the managers of the company get to decide how they're going to use that money. Do they use that money to purchase more product? Do they use that money to generate more sales? Do they use that money to design a new product? Do they use that money to potentially pay a dividend? What's the best use, the highest use of that capital? That's a very complicated, very hard decisions to make. And some companies do a lot better making those decisions than others. And different sectors can be much different than others also. So there's a study out by, I believe it was an Arizona State professor, Henrik Bessenbender, where he determined that about 96% of the stocks in the stock market just perform baseline. So they're producing what a T-bill on average would produce. And about 4% of the stocks in the market over long periods of time actually produce the excess returns. So, when you're looking at businesses, it's very hard to choose exactly which ones are going to be the winners. There's no cut and dry, no specific formula to do that. So when I think we give advice, when Ben gives advice also, you need to own a very broad set of stocks in order to benefit from that power of ownership in the markets over time. Obviously, if you have your own business, it's very different, right? You're very concentrated. You're very involved in your business on a day-to-day basis, and you have a lot of skin in the game. You're wearing a lot of shirts, wearing a lot of hats, and it's producing food, resources for your family to live on. So I think that's a private business like that's quite different. Once we're concentrated, there's a lot of risk involved too. But when we talk about publicly traded stock, very hard to pick those exact winners. So we like to look for a broad ownership there when it comes to stocks.
I would agree, right, Nick? I mean, at the end of the day, like ownership in stock, or why a company or corporation issues stock, is because it's like a capital fundraising. Maybe not all that different from what you would see in your local church, where they're like, hey, we have this initiative, we want to expand the church, maybe we want to remodel it, perhaps add a school. I mean, whatever the objective or goal is, it's really not that different, except that where maybe you give your contributions to the church, and you're helping it to take on this new initiative. The thing that you get in turn for that is maybe just a tax deduction, or just the good, and knowing that, hey, I'm helping to promote or provide good in the world. As a participant in a company or corporation, you're hoping to see a return on that capital fundraising. But there's no guarantee that just because this money's been handed over, that the money is going to come back. And at the end of the day, what could very well just happen is the money just gets spent, maybe poorly, and there's no business on the other side of all that spending. What'll happen is we just spent a whole bunch of money and we really have nothing to show for it. And that can just as happen, spending and having nothing to show for it can happen just as much in a business or a corporation as it potentially could happen, on the personal individual side. And so there's one is like returns aren't guaranteed. Like we don't know for sure that the business objective that this company is pursuing is actually going to pay off. But two, like the other piece that's interesting about purchasing, stock on the open marketplace, individual companies, individual stock as we'll often call it, is the price that you pay for that stock. It's market driven, it's based in competition, but it's not always a good valuation, right? Maybe you have the risk of overpaying, of the ambitions, the aspirations, the expectations of what that company is going to accomplish become too hyped up, too inflated, and you just pay too high of a price. And even if they do actually accomplish all the things they hope to accomplish, it doesn't turn out to a good investment for you because they still don't generate enough revenue, profit for what you paid on a per share basis. So there's all that to say, Nick, is that there's a lot of volatility in the possibilities of what may happen to capital if you go with an individual stock. Certainly the possibility of it may be a huge payoff, you make millions of dollars, something like a lotto, but there's also a really large gamble. And maybe to the point that you were just making a moment ago, statistically, the odds aren't all that much in your favor for the company, just because the competition is so fierce, intense. Like easy money doesn't exist and isn't a thing. And so a business can't just go out and rake it all in. That's what all the other businesses are doing too. So perhaps to use that then as a segue. So we've talked a little bit about stocks and just like that, a basic building block of what makes an investment. But I think neither one of us or most advisors would recommend too much in individual ownership of stock because of the gamble that's associated with it. What's maybe another investment vehicle that our listeners have heard that is more recommendable that would also be out in the marketplace for their consideration?
Sure. And just to add just a little bit more on what you said, I love what you said there, Ben, is that I think it was so Isaac Newton back in 1713, he was a stock owner back in a kind of a different form of the stock market that we have now, for sure. They're nowhere near the amount of companies, but he owned the South Sea Company for a while. Was very happy with it. It just paid a 5% dividend, and the company's share price didn't move a whole lot in the first years that he owned it, and then something called the South Sea Bubble came along and drove that stock price sky high. And he's one of the smartest people to ever live. But he ended up, he made maybe a 30% gain on it. He said, "This is crazy. I'm going to sell it." And then the thing went up, 1,000% beyond that. And all his friends were talking at parties about how they were getting rich. And he bought back in, overpaid for it, like you said, bought back in with the capital he had sold at the top. And then we all know what happened. It crashed like the tulip bubble, like the internet bubble, so forth. And ended up wiping out about a third of his net worth. He didn't die a poor man in the street, but it did wipe out a considerable part of his estate there. He actually ended up gifting most of it before he died anyway, and that's a good principle as far as Catholic investors. I think we need to focus on stewardship and generosity a lot, but it's just going back to paying too much, getting swept up in the craziness and the manias, so too much in one stock, definitely need to avoid that. Not prudent. So some vehicles that are available to us now that were definitely not when Isaac Newton was investing. So maybe he would have taken advantage of them.
Right.
So possibly, I'm sure you've all heard of mutual funds, exchange traded funds, are two big examples. An older version of that is closed end funds. You've probably all heard of hedge funds as well, which are a little different. But we could start with a mutual fund. I think it's still the most commonly used vehicle out there as far as being able to invest in many different stocks and potentially other vehicles such as bonds and cash and et cetera. So that allows you as an investor to buy shares in a fund. So the mutual fund is actually like a company itself who purchases, hundreds of different stocks on the market, and they're able to do that as an institution. So they're usually able to do that on a fairly economical basis. Although, caveat there, some mutual funds charge a lot more than others. So it's something to take into consideration when you're evaluating and comparing things. And these mutual funds allow you to be a shareholder in that pool. So you don't have to go out and buy the 2,000 different stocks out there. You can buy a share of the fund, which would own a lot of those stocks. If not all of them, maybe a good amount of them. So you can be diversified in that manner. They're very liquid, so you can sell them on a daily basis. And I'm sure you've heard of exchange traded funds also. Those are a newer form of fund. They are getting mature. They've been around for quite a while now. But as a difference, a mutual fund, you can only sell it on the market at its net asset value. So whatever the shares underlying investments are worth at the end of the day at 4:00, you can liquidate any day that the market's open at 4:00. An exchange traded fund is a collective investment vehicle that allows you to you can sell your shares in that venture anytime throughout the trading day. So anytime the market's open. So if you wanted to sell at noon, you could. You don't have to wait till 4:00 to sell that investment. So it gives you a little bit more control over potentially what price and what time you'd sell that investment. Also you can purchase throughout the day as well. To me, it's a lot of times a lot easier decision to purchase a vehicle than when to sell it. But as long-term investors, maybe the intraday trading doesn't matter as much, but it is a difference between mutual funds and exchange traded funds. And then I know we've talked about this a little bit too, but the exchange traded funds, so a mutual fund just sells at a certain price at 4:00. An exchange traded fund can actually trade at different times throughout the day, but it also can trade at a premium or a discount to what its underlying shares are worth, which is interesting. So its price can get bid up to be actually where it's the shares are selling for more than the underlying shares of the stocks are worth, or it can be underbid and sell at a discount. So, it could sell for maybe the underlying shares are worth $22, but the ETF is liquidating or selling for $20 a share. So you'd have a 10% reduction there or a discount in the price. So that's something to take consideration too. Liquidity also. Mutual exchange traded funds can vary a lot in liquidity. What that means is, how quickly can you sell those? Is there a buyer for those shares that you're selling? And a lot of that can also drive that premium discount. If there's a lot of demand for the fund, it might have a premium. If there's not a lot of demand for it, it may have a discount. And they can also use a lot of different strategies. So exchange traded funds, even more so now, they can use something called leverage, which can be very positive. It can be a negative thing as well. I'm sure maybe some of you out there have heard of the long-term capital management disaster where a fund that blew up on leverage. So that's kind of a detailed subject, and we may get into that a little bit more. But to answer Ben's question here, and what are some vehicles that we can use to invest in a diversified manner throughout the marketplace? Mutual funds and exchange traded funds are two big ones there, and hopefully that gives you a little bit of idea of how to distinguish between the two.
Yeah, well, thanks, Nick, for sharing some of the details on that. I mean, I think some of the key takeaways I'm going to have with your final comments with like this notion of diversification. Like one of the main benefits you might pick up within a mutual fund or an ETF that you wouldn't have within an individual stock is that we just, potentially you could put 100% of your money in an individual company and let it ride. And the truth is, if that company does really well, then, because you have such a concentrated bet, you could come out, with millions. It's almost like a lotto ticket. Like, I mean, things could go really well for you. Of course, on the other hand, given the odds and the struggle and the difficulties of things, performing really well, you could just as well, lose everything. And so just going back to the old adage that I'm sure you all have heard, you don't want to put all your eggs in one basket. The notion here is let's spread the money out and not take such a gamble. And in fact, actually, if we get into like portfolio theory and management, there's a notion of like what's called risk-weighted returns and risk, like what's the way to get the most return for the risk that I'm taking and hit this point of optimization or efficiency and building a portfolio that, delivers that. And so, I think we could get into much more, I suppose, technical details than perhaps we should, but just to stay more on the broader concept here is the question of, what's the payoff of going with a mutual fund or an ETF that you wouldn't have with an individual stock, and how's that working or winning for you as an investor is that, we aren't taking near as much of a gamble, conceivably with that mutual fund. We're spreading the money about into multiple companies. Could be still just a handful, a couple dozen companies, or it could be into the order of thousands. It really depends on that fund's objective and what they're seeking to accomplish. And to the point that you brought up, Nick, I mean, a mutual fund in its own right, it's kind of an interesting vehicle. It is its own company too. It's like you're investing in a company that invests in other companies, and then receiving rewards in tow. So on the whole, I would say, this tends to be just a smarter way to invest because, we're just minimizing our risk. There's no, what's the upside or the value of taking a lot of risk in an individual company? Are we really getting compensated fairly? Could be the question, especially if at the same time, you could take all the risk of one company versus taking the risk of multiple companies. And perhaps let's say the returns were the same. In that situation, it would be rather obvious, like, well, I shouldn't invest in that one company. I should do it in the broad diversified portfolio. Like that point brought home is like, well, how much of an upside am I getting if I do just individual stock selection? Could I get comparable or similar returns and not take on that risk? That's where, portfolio management or theory really starts to come into play. So we've talked a lot about, Nick, the different types of maybe funds, mutual funds, exchange traded funds. You could commonly see these within maybe a 401k offering, and then you have the possibility of building a portfolio, not just in one of these funds, but in multiple ones. But, what we haven't talked about, we've talked primarily so far in the podcast is about stock ownership. But stocks aren't the only asset classes, we like to call it, that's available to us. A few other broad types of asset classes would be something like fixed income or even commodities and real estate. I'm kind of curious, if to pivot a little bit, as another asset type, if you were to have fixed income investing, like what is that and how does that vary a little bit from stock investing?
Sure. So that's like you said, Ben, it's a very large part of the overall investment market. Stock market investing is just a piece of what's out there, the universe for investing. So to your question on fixed income focuses more on creating income. So for someone who wants to receive a certain amount coming in from their investment on a consistent basis, something that's steady, something that you can count on, almost like a paycheck, right? Or a form of a pension to some degree, where you're investing in a bond, as an example, and it's paying you a coupon of let's say it's 5% a year. So, you put in $100,000, you're getting $5,000 per year. Maybe that's paid monthly, maybe it's paid quarterly. But you're basically buying that investment to produce an income stream, to produce a paycheck. You're not buying it to be an owner of a company. You're not buying it to see your capital grow above and beyond that interest payment, that coupon. However, it can, fixed investment prices do fluctuate also, maybe not to the degree of stock. That's another conversation too. Fixed income, you have fixed income that's quite stable, and then you have fixed income that's more speculative. As we've seen here in the last couple of years, fixed income as an asset class in general has performed quite poorly. The advantage though is that it still pays that income to you, even if the principal price of that investment is not doing great. You can still count on those payments most of the time, as long as the issuer is solvent and able to pay the bills. So, when the Fed started raising interest rates, that has a negative effect on bond prices. So kind of just like a seesaw, right? If rates go up, bond prices tend to go down. And then the longer the term of those investments, so a 20-year bond is going to decrease at a lot faster rate than a 2-year bond would, just because they have more leverage on them, and the prices would decrease more with rising interest rates. However, a shorter term investment would pick up on that new interest rate quicker. So there's a lot of complexity there with fixed income investments. But back to Ben's original question, usually someone would buy those because they're counting on or wanting some sort of a paycheck coming in. It's money that's producing something for you to receive immediately, and not something that's maybe you're looking to harvest 10, 15, 20 years out in the future.
Right, Nick. And then, so, fixed income, as it maybe fits within the portfolio, has a different, it just serves a different purpose, right? Of what we hope it to do. But, just the asset that underlies it, which, we call it, I suppose, fixed income, and perhaps that's fair enough, but it's really maybe properly just thought of as a bond or a debenture. It's a lending instrument. It rather than taking ownership in a company and receiving the benefits of profit and the company becoming more valuable, and then, consequently you can sell it for more. Those are kind of the fundamental benefits of stock ownership. So as much as there could be profit and it becomes more, but at the same time become completely worthless, a fixed income or a bond asset is really just a lending arrangement. You've decided to give your money over this other organization, but they are, just like with any debt obligation that we might have on the personal side, like with your mortgage, the intent is to pay that money back. And so this organization that you've lent your money to has to pay, stated interest rates, coupon payments, as you alluded to, and then eventually has to pay you the whole principal back, depending on more or less whatever contract that's been established. And so, provided the organization itself may not be doing particularly well, and it may struggle, and it may not increase in value one iota, and they may not even driving a profit, but you as an investor in this situation can still benefit, because as long as they at least make their payments and are able to give the money back, pay the money back in full, then you're still whole on your money. And so you're not quite tying your financial future together. Like in a stock arrangement, well, this is going to pay off if this company does really well. In a bond arrangement, well, the company doesn't have to do really well, as long as they make their payments, I'm fine. And in fact, actually, if they even go for bankruptcy, you stand, ahead of the stock owners in terms of getting your money back. And so it's a little bit of a safer investment, on a number of levels. It depends on the lending institution. Are we talking about a government that we're lending the money to? Are we talking about, a large company? Are we talking about a small company? There's risk still in this situation, but it's more reliable because of just this underlying nature of an investment. Do you find them maybe, bonds are kind of this interesting thing. People, when they approach us, they're like, I don't know if I want to invest any of my money in bonds. And, what's your initial take of that, of a bond investment?
Yeah, usually it's people are fairly hesitant when it comes to bonds. You're right. Most of the focus is on the stock market. You had a great definition there. You're lending your money with the expectation of a certain fixed rate of return, and you're getting paid back, and eventually you get the entire amount back. So you're kind of acting as a bank, right? You're being your own bank and lending that money out. But it just it serves a different purpose. It doesn't get nearly any of the hype that the stock market does. But in an overall financial plan, when you have different goals for different pieces of money and different situations, a lot of time it's something that really needs to be considered and analyzed, and maybe even worked into the situation, especially if you're trying to solve for a certain amount that you need, per month to live on a consistent basis, right? Because really, for people retiring beyond Social Security, maybe some people are still lucky enough to have a pension plan, but most of those have gone by the wayside, especially in the private sector, right? So you used to be able to maybe count on your company paying you a certain amount per month in retirement, but now it's besides Social Security, it's pretty much up to us to create that paycheck when we retire. So it can be a very, very important piece for those payments for stability in retirement. And as you alluded to, Ben, there's a lot of different issuers out there. So it's very important to consider the company, the credit quality, obviously, what they're offering and all the terms thereof. And back to our original conversation, you can buy individual bonds like you can individual stock. You can also purchase funds, right? Like we talked about, mutual funds, exchange traded funds that would cover a broad universe of these fixed income investments.
Right. I mean, just as much as you have stock mutual funds or stock ETFs, you have bond or fixed income, as they're also commonly called, mutual funds or ETFs. And then you can buy the items individually. Our general recommendation or advice or approach would probably be mutual funds and ETFs, but depending on where you're at and what type of investor you are, it could make more sense to pursue individual bond holdings. I mean, it's hard to give anything that's too broad of advice here. Like they all are various tools that can be put to use and have their value or their moment. Yeah. Not all that different maybe from a carpenter's toolbox, right? Where some of the tools you don't always use, or it's only in very rare specific occasions. The different investment vehicles can be similar, where some you use all the time and make a lot of sense, and other times it's all really only on a specialty arrangement would I pull out that type of investment, because that's when you use it. Like that's when it makes sense to put it to be applied.
Oh yeah, just to add on to what you were saying there, Ben, which is very interesting. Different situations, different accounts. We didn't really hit on it too much, but taxes are an important reason why someone might own individual securities versus funds. For example, different types of accounts. So in a retirement account, it's all tax deferred or tax free, depending on what kind of an account it is. But if it's not a retirement account, not what we call a non-qualified account, just a savings, brokerage account, investment account, it's taxable as you go. So sometimes if you own individual shares, individual bonds, you have a little bit more opportunity there to offset gains with losses. Or if you have a fund, sometimes you're paying for other people's gains in a non-qualified or non-retirement account. So those are important considerations when you're choosing what vehicle, so that the tax location of where you're buying those investments and what kind of investment they are is also an important thing to look at. And that's probably a lot more detail than we have dive into today, but it's a consideration.
Yeah, I mean, I think as we've been having this conversation, Nick, it's just come to light like, golly, there is just so many little variations on these themes. And, we wanted this to be kind of an introductory piece for anybody that if you just really never knew what investing was and you're like, I don't even know what that means, this episode would be a chance to at least explain in broad strokes part of what it is that you're doing as an investor. And maybe as we're looking to wrap up, we can speak back to that theme. But before we do so, I mean, there is a fair amount of fine texture and detail that comes into this. And, we do it every day. And I think sometimes you just kind of forget about it at all because it becomes happenstance. But as we've been talking about, it's like there's so much of it we haven't talked about that, could make its way in, but it would become, this podcast episode would become hours, not days long, to try to interweave it all in. It would be difficult to touch about it all. It's I suppose that's the nature of the work that we do. So perhaps before we pivot and talk about the investments, I'd like to just make a plug for the Catholic Financial Planners Network for anyone who's listening. If you're looking for an advisor, looking for some help or guidance, in this space on you want some help with your money, but you're just not sure what to do with it. You're finding yourself in that situation. By all means, let's connect with one of the advisors we have in the network. We've got many of them, joining and coming, and folks from all over the country with different areas of focus and specialty. Hopefully we can find a good advisor that works for you. But yeah, I mean, Nick, as we wrap it up with this question of investing, I mean, it really is this like investing is like having this excess in your financial situation. I've got more money than I know what to do with it. And what can I do with it? Like, where does it apply, and what kind of opportunities, lie ahead of me, and what's something that's worth pursuing? What's the risk? As you stand with 20 years of in the experience, and then your dad's work prior to that, I mean, yeah, what do you think, as you look into the future and the market, like, what have you found to be compelling investment? Like what makes sense as a good place for people to be thinking of what to do with their money?
Over the time that our business, that we've been in business, obviously being diversified and being exposed to the stock market, and the stock market has been the best driver of returns over all that time. And I think we'll continue to be so as long as you're long-term focused, a long-term investor. That capital will compound for you over time, and you'll reach escape velocity where you've just made so much above your initial investment that even a bear market's not gonna phase you too much. Obviously, it still hurts, but there'll always be bull markets followed by bear markets followed by bull markets. But the trend over the long term, because these businesses as a whole are able to compound their capital effectively, you get to tap into that, which is a quite powerful use of your capital. And I always remind my clients that you don't come to me for me to make you rich. You come to me so that you don't have to do it all over again. So, it's we're here. There's a lot of there's a lot of questions out there, but I think just keeping that long-term perspective is so important, and letting the markets work for you can bring a lot of benefit and help you achieve those goals over time. And we've seen a lot of our clients might when they retire, maybe they don't stop working altogether, but they do have that financial freedom to do work that they enjoy, right? So we always need to keep doing something in our lives that's positive and productive. So, but just having that freedom that you can gain through a proper investment strategy can help make your life a lot more enjoyable.
Right. Yeah. I mean, investments, the market as a place to put your money, and we're kind of talking about the market being just all of these various companies that are all competing and working against each other. Like, every one of these companies is looking to turn a profit and make the best use of the money that's been given them, the capital that's been given to them. And companies do come and go. There is turnover. Not everyone makes it. Not everyone stays around. And and not everyone perseveres, but as like a gamble, like is this maybe this capitalistic push to try to do better and to have to make a return, in aggregate, is that a fairly reliable bet? I think we're of the opinion that, for the most part it is. And now, is it like a bet that will make you fabulously wealthy? Like, maybe. I mean, if you start this early enough and you just stay disciplined and investing, actually you can come out ahead doing just fine with not taking any more of a gamble than that. But I mean, I suppose when I'm suggesting fabulously wealthy, I'm meaning not just having millions to your name, but like tens of millions or hundreds of millions or billions of dollars. Like, no, I mean, if you're looking for wealth of that nature, simply investing in the broad market, not gonna do it. You're gonna need to go, more concentrated, more focused, and either look into a real estate empire or maybe start a company from the ground up and see where it goes. Like, those have the possibilities of turning into tens of millions, hundreds of millions. Just simply putting money in the market probably won't, but so the market is a great way to either have, a place to get returns, that are fairly reliable and safe to the extent that we've got time and the willingness to be disciplined and wait for them. But they're also there, but if we're just wanting a straightforward, simple path to wealth, I think the market does just fine too. It doesn't have to be complicated. We can, in a lot of ways, when you're investing, we're giving our money over to someone else and say, hey, do with this money as you're able and make the best and good use of it. And, we can do that pretty reliably in today's financial markets with the funds that are available to us. It's really, I mean, we haven't talked anything about the history and the change in these funds and the transformation that's taken place. But as an investor in today's financial services, like it's incredible. Like, I think the possibilities of where it could come and the safekeeping, if you will, I have to put somewhat quotation marks there because there's always risk in a gamble and uncertainty, but it's a fairly good bet that we can make into the future and one that we can have confidence in and ultimately allows us to sleep at night, not near so volatile and uncertain. So, Nick, with some of these concluding comments, it'd just be great if you could just share a little bit more. If someone's, found a lot of value in this conversation and connecting with you and learning about some of your background, how, where should they turn to learn, to follow up with you and get connected?
Absolutely. Thanks, Ben. So you can find us online. Our website is orenduff.com. So like our business, Orenduff and Associates, it's just ORENDUFF, so 2 Fs.com. You can also reach us here in the office at 804-673-6633. And always looking forward to catching up with you maybe on LinkedIn as well. You can find me as Nicholas Orenduff, Certified Financial Planner. So, and of course on the Catholic Financial Planners Network, we're all listed on the website there. So,
well, great. Well, thanks, Nick, again for joining me on today's call. And we're tiptoeing into this space. It's one that's certainly filled with a lot of technicalities and more we could have gone into greater detail on. But I sure hope that it was a good introductory approach for everyone who listened, and you've had a few takeaways between just clarifying, what is a stock, what's a bond, what's a mutual fund. Like, none of this makes any sense. I'm hoping you got a little bit of a sense as to what these different types of investments do for you as an investor and how they could make sense. Please continue to tune in and listen. We love having you as part of the audience, and we're looking to generate great content for you. If you have any suggestions, thoughts, or recommendations on what you'd like to see at a future topic, please reach out at info@catholictfpn.com to give us that feedback. We'd love to hear it. So in the meantime, God's blessings to each and every one of you. Bye now.
God bless.